In the case of Netflix, I decided to buy the stock because the vol wasn't as pumped as I'd hoped it would be. So I bought the stock. And then I started writing calls as it kept falling. I started writing calls against it. Ryan said, well, Jon, describe your laddering of how you do it. Generally, when I'm buying a stock that has done that, I'm buying between 5,000 and 10,000 shares. And then I'm selling 25 calls against it in the front week, 25 in the next week out, 25 in the next week out, 25 that are a full month out into the future. So that's obviously, folks, only if it has weekly expirations. So in other words, I'm covered for all 10,000 shares or whatever. Not safe. I'm not saying safe. I'm just saying I have now a covered right for all 10,000 shares. And then every week I'm buying back the expiring week option and rolling that out to 4 or 4.5 weeks, depending when I buy it back, into the future. And by doing that, I will hit a lot of higher strikes if it's a rally mode like Netflix was, like FedEx has been. I'm not saying they're exploding to the upside. FedEx didn't, but Netflix did. But I just start, selling. So I'm short the 200s, then the 210s and the 220s, then the 230s. Then I buy those back and roll them up and just keep doing that until finally it made that earnings pop and I just let it get called away.